Welcome to our LATAMPaper November 25th. The year is almost over. We have big projects for next year. We are very excited.
By year-end, expect a slow but not broken global economy, growth running near the IMF's 3.2% track for 2025 with a clear soft landing bias, inflation drifting lower but not perfectly tamed, and the Fed already in a cautious cutting cycle that gently eases global dollar pressure without unleashing a party. Most major central banks will talk tough but act pragmatic. They're more scared of killing demand than of the last decimal of inflation. So real rates edge down, liquidity conditions improve on the margin, and risk assets stay supported, especially in AI. Infrastructure, energy transition, defense, and nearshoring plays, provided nobody in politics decides to cosplay as 1930s-style protectionists too aggressively. Boardrooms and traders, however, will close the year with cautious, defensive optimism. Manufacturing PMIs hover around the 50 line. Services remain mildly expansionary, but forward-looking sentiment is subdued as tariff brinkmanship. China, U.S./EU frictions, Middle East risks, and shipping choke points hang over 2026 margins. Practically, that means tighter risk screens on supply chains and counterparties, more contractual pass-through of costs, selective capex rather than broad expansion, and a preference for high-quality balance sheets and politically safe trade corridors. Latin America limps into year-end with flat to fragile consumption and selective strength rather than a broad boom. Real wages have recovered only partially and households are still digesting years of high inflation, so mass market spending stays subdued, except for pockets of resilience where formal employment, remittances, and social transfers support demand. Regional growth hovers near 2.4% with disinflation progressing but incomplete, and limited fiscal space caps any political temptation to buy votes. That means no big Christmas demand miracle. You plan on stable to soft volumes in non-essential goods, hold better in food, pharma, and affordable staples, and treat premium categories as niche plays, not a macro thesis. On exports and liquidity, the story is more tactical than tragic. Commodity volumes, energy, mining, agri remain the backbone, but face slightly softer prices and noisy politics, while nearshoring keeps Mexico and a few manufacturing hubs structurally interesting, even under higher U.S./Mexico tariff noise, as supply chain diversification doesn't reverse, it just gets messier.
Containerboard demand is more cautious to take big volumes without real orders, adjusting stocks as real orders of boxes comes in line. We feel that regular suppliers in the region are stable, although we see some aggressive offers from non-regular players. Most of the orders for high season are done, and thinking more of the supply strategy for 2026, we don't see the demand within USA improving till Q3 of next year, but anything could happen. Recycled paper from Europe are adjusting demand due to the increase of energy. In general, we are seeing €20 increase, but demand on this grade is low. Pulp. London Pulp Week is over and the sentiment are mixed feelings. In terms of hardwood, the tendency is upward, but demand is not great due to the Chinese pulp integration, which takes a good portion of the exports of South America suppliers into China. On softwood, the trend is downward due to yucca substitution and low demand. Seems that the size of the market for long fiber is squeezing.
Thank you for watching. See you soon.